Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit homegain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to homegain.com. Welcome back, Real Estate Radio. This is Ryan Sloper, your host, joined by my guest, Louis Cammarosano, the general manager of HomeGain. Before we went to break, we were discussing what's on deck in the markets this week, what can affect interest rates and you and your real estate decisions. The big thing that we're going to focus on for this week that can affect interest rates is going to be the jobless claims, which is due out on Thursday. It's expected to be up 3,000 to 400,000. Claims in the past 6 weeks have been hovering at the 400,000 to 412,000. So I really don't think there's going to be much of a change there. I would say that probably interest rates are probably going to stay about pretty neutral throughout the week. I don't really think they're going to move one way or the other. The 10-year note and mortgage-backed securities have been at pivotal levels over the last couple weeks. Both testing their respective 20 and 40-day moving averages. So I really don't think that we're going to have a significant enough of an event to really move them one way or the other. Safety has continued to move money into U.S. Treasury, which is keeping interest rates from increasing. But there's really not anything that's going to, I think, move it so that we're going to see a swing down into the high 3% range for 30-year fixed mortgages. I think they're going to stay around that 4% range.
Ryan, did you mention that when the Fed met, that I believe they put in their notes that the possibility of purchasing mortgage-backed securities?
Yeah, I believe that that's going to be a trend that's going to continue to take place. I believe that they will start to purchase more and more mortgage-backed securities. Ultimately, this was something that they did in the initial QE1, where they bought a tremendous amount of mortgage-backed securities, which helped us get the huge swing in interest rates down into the lows that we had seen. And then now they're talking about buying more of them to try to keep interest rates low. I don't know what effect that's going to have, Louis, because as you and I have talked about in the past, the market's kind of already they're factoring this stuff in. I don't know how much them buying is really going to push them down much further than where they're at.
Well, you had mentioned last week a correct point that purchasing the 10-year Treasury may bring the 10-year Treasury down, but it may not have the same impact on other consumer-type debt instruments.
Yep.
However, purchasing directly the mortgage securities does create less of a demand for them, so that could have an impact on keeping interest rates lower more than Operation Twist, which is the purchasing of the longer-term maturities, which you had mentioned last week that after they instituted that, interest rates actually went up.
Yes, they did. And really, I think for the next foreseeable future, I'd say the next 6 to 12 months, I really see interest rates moderating around the 4% to 4.25% range. I really don't see we might get these little dips down, short term into maybe the high 3% range. They might, trend upward for a little while, but I really think over, the long term of 6 to 12 months, I really think that they're probably going to stay in the 4 to 4.25% range. And the Fed really wants to see that because they're trying to keep, I guess, I don't know what you'd say, but keep real estate moving.
Right.
And
if you do see them if they do see them rising, I think their reaction would be to pull the trigger on purchasing the mortgage-backed securities.
Absolutely. That would happen, I would imagine, relatively quickly if we start to see that. That's going to be one of those things that they had already mentioned it, so it would just be a matter of, okay, we got to do something.
But it sounds like that's been approved. More easing hasn't been approved, but it's semantics because that is easing. Where are they going to get the money to buy those things?
Yeah, just print more money.
Right.
Like usual. Interesting here that I was reading an article, and it was saying that Freddie Mac has had steep losses in the third quarter of this year. And for those of you not familiar, Freddie Mac is a government-controlled, government-sponsored enterprise, and they're back in the red and asking for an additional $6 billion from the federal government to help soften the blows of reduced interest rates via refinancing. So a lot of the refinancing at the lower rates is actually affecting these GSEs because they're not able to have the same returns that they were having before when interest rates were at 6%.
But that's why I said, why would a bank right now want to lend any money for 30 years?
Yeah,
at these low rates.
And if they do, Louis, why wouldn't they be completely strict with the guidelines and make sure that all the I's are dotted and T's are crossed and the property, the collateral's good, credit
Right.
scores are good, income's good, and verifiable. I mean, really, they're protecting themselves.
Sure. You're going to take the long-term risk on a 30-year note, and then also have to take the risk that the person might not even pay the pittance of interest that he owes you.
Yep, and I mean, and they're more inclined to take that risk when they're getting maybe a 6 or 7% return.
Sure.
You know, at 4%, it's kind of like, okay, well, we're not making hardly any money here. We want to really make sure that this is a sound borrower.
Well, and it gets worse if then interest rates rise, and they're only getting 4% 3 or 4 years from now, and interest rates are 7 or 8%. The bank is really not going to do well there either. I mean, right now, one of the things the Fed keeps saying that they have to keep interest rates low, that somehow they're doing this for the benefit of the consumer, so the consumer can spend money and have access to credit. Really, what they're doing is they're keeping the banks solvent, because if the interest rates rise, the banks are in a very bad situation.
Yeah.
It's in a sense, it's a way of bailing out the banks without having to bail them out by forcing the interest rates low.
Yep.
Keeping them low.
Yeah, and actually,
if this really was helping the consumer, we'd be out of the recession.
Yeah, it's not helping the consumer at all. Like, there's not. It's amazing to me that everybody's like, oh, you know, interest rates are so great, but yet there's so few of people that can actually take advantage of the low rates.
And also, spending money is not what fixes the economy. Spending borrowed money is even worse. It's production that fixes the economy.
Yeah, and I mean, and we've seen over time that people have, it seems, moving to become more fiscally responsible, actually saving money now versus spending every dime that they had. You know, maybe paying down debts a little bit. I actually, last show we had talked about, you know, it looks like banks are starting to lend more in the form of credit cards and stuff like that. I know I've seen an increase in my mail. I don't know about you, Lewis, but I've had more credit card offers over the last 2 months than I've had over the last 3 years.
So I get those, but let's not confuse saving money with paying down debt.
Yeah.
And most people aren't saving money if they're paying down a credit card debt. There's no money to save.
Well, and they could be doing both. You know what I mean?
Well, not if you have an outstanding balance of $20,000, and you're saving, you know, $20 a month, and you're paying down $500 a month on your credit card. You're still net negative.
Yeah, I agree with you.
Not really saving money until
you're basically debt free, right?
Exactly.
And then putting money in the bank, which that's, you know, the majority of the country's not going to be in that situation.
Well, and also, putting money in the bank isn't the smartest thing to do either if you're going to get 1% interest rate. So it forces you to put your money into riskier assets like stocks, or I guess if you're smart, you put some of it into gold and silver or some other commodity type asset.
Yeah, and, you know, I think really diversifying, and I think you were being 1% is an awful high. I would say most banks are like, what, 0.001?
Well, I'm saying, yeah, if you actually have enough money to put into a CD, they might give you 1% if you lock it up for 5 years, or I don't even know what the rates are anymore.
Yeah, I know. Well, you know, my grandmother's constantly trying to find the CD that's paying the most amount of money. And it's just funny because I think the best that she could find is like 1.5%, but that's like, you know, a 3 or 4 year CD.
And then you pay tax on that too.
Yeah.
Not that interest.
Yeah, and you bring up a good point with the Fed as well. There was the Boston Fed president, Eric Rosengren, said that the central bank should act to bring down stubbornly and unacceptably high joblessness that's been struck near 9% or above since April. So it looks like they're making this big concerted effort now to really jump in and try to figure out this employment situation. He went on to say that given the very weak labor market conditions and the low expected inflation rate, the Federal Reserve should, in my view, continue to take action to aggressively try to reduce the stubbornly high U.S. unemployment rate. He forecasts inflation will be below 2% for over the next several years. Now, I have a big issue with this whole inflation thing. Louis, you and I have talked about this in depth about, you know, they like to factor out the food and energy component of inflation.
Right.
And for them to say that it's going to remain at 2% over the next several years, I just can't see that happening. It's not possible. I mean, oil prices have been rising slowly, like we were talking about last week as well. Food prices have been rising, which are the majority of people's bring home money. That's where it's going. It's going to food and gas. Get them to work, and when they come home to eat. And I just don't see, and we know that probably in the coming months or year or so, we're going to be printing more money. It's just a matter of when, I think. And I really think that inflation is just going to tend to edge up if you're actually taking into consideration those two items. Would you agree?
Yeah, of course. And if you look at all that we talked about it earlier, all the possible reasons why they might need to or have to print money, you've got every sovereign entity in Europe. You have all the municipalities in the United States. You have all the states in the United States. You have reasons for stimulus to print money. They have any number of reasons to want to or claim to need to print money. And when you increase the money supply, you have increased inflation. Now, they can say that the effects of inflation are only 2% because of the way they calculate inflation by using hedonics or saying we're going to strip out food and energy. But the actual impact on the consumer when there's more money flowing around the system is they're going to pay higher prices. And when you have high unemployment and you're unemployed and you have to pay more, that's not helping anybody. And remember, the people who get the money first when they print the money are the ones who benefit from it, and those are the banks.
Yep.
People who end up at the end, their money's worthless by the time they get it, by the time it flows through the system.
Yeah, and the one thing, as far as, real estate radio, we're always trying to show people the opportunities, and we are talking about future inflation and what that means to people. And if they're able to lock themselves into a long-term 30-year fixed mortgage at 4% or below, obviously depending upon your qualifications, you can really protect and shield yourself against that future inflation.
Well, you should think about if one of your major costs is going to be your cost of shelter. If inflation runs through the entire system, rents are going to go higher.
Yep.
There's nothing you can do about that. What you can do is if you own a home and you have a fixed mortgage, your mortgage payments will not go higher if you have a 30-year fixed or a 10-year fixed.
The only thing, and the only thing that can change is your property taxes and your insurance.
That's correct.
And but as far as your biggest expense, which is your principal and interest that you're paying out, that is fixed in for 30 years.
Right. Now, your home may go down in value. It might not go up in value, but at least your fixed cost in 2011 terms will be the same in 2015, 2016, when your rent cost today may be the same as even if it's the same currently, let's say rent is $2,000 and your mortgage payments after tax and everything is $2,000. 3 or 4 years from now, your rent may be $4,000.
Yep. And it's important peace of mind. It's important peace of mind for people too. You know what I mean? To know that they have that security of things locked in for an extended period of time.
And one other point though, when you do have inflation, maybe your wages don't increase at the rate of inflation.
Yep.
But you'll make more money if you have 15-20% inflation. You might get 5 or 10% more, which will mean it's even easier to pay down your mortgage.
Yeah, I totally agree. When we come back, Lewis, we're going to jump into how to take advantage of these low rates and what are the best practices in trying to shop for a home mortgage when we come back.